Welcome to the Capital Spreads weekly update. Today is Wednesday the 7th of April 2010 and we're pretty much flat on the week so far, and obviously the week in the UK has been dominated by the announcement of the election. No surprises there at all. We'll all be going to the polls on the 6th of May, and as it looks at the moment, we could possibly see a change of government from Labour to Conservative, but of course with the campaigns ahead, anything can happen to those polls and anything can happen to the result. But we'll be keeping a close eye on those polls as they have been affecting the markets to some degree, certainly on the cable market. Sterling often selling off every time there looks like the polls are narrowing, and making a little bit of a comeback whenever it looks like there's going to be a clear majority for a Conservative government. So that's certainly the highlight of this week so far, and as well as that, obviously there's been a little bit of a fluctuation in the FX markets, in particular the euro. Concerns over Greece once again. Borrowing costs for Greece spiking, and it looks like there is a little bit of disagreement within the Eurozone as to how much Greece will actually have to pay for any bailout, whether that bailout comes from the European Union or whether it comes from the IMF. And of course, on top of that, their growth has been a little bit worse than expected, so we've seen an increase of their budget deficit, so the euro taking a little bit of a hit there. And as the week gets underway, we've just sort of traded a little bit higher after the Easter holidays. April on the whole is a positive month historically for the UK market and equity markets as a whole. When you look at the FTSE, out of the last 26 years, we've seen 19 increases in the month of April, on an average of just over 4%, and any declines have been pretty muted, just over 2%. So historically speaking, April is a very positive month for equity markets, and recently we've seen some relatively positive economic data. Last Friday, US employment numbers looking pretty buoyant, and so we're just gradually grinding higher. So the current situation, FTSE's around 57.75, the Dow around 10.950, and the S&P 11.87. On the currency and commodity front, sterling has made a little bit of a recovery back to 152.00, and gold also has benefited from the sort of renewed concerns over the Greek situation. It's testing highs around 11.40, currently around 11.36. So we've seen the markets continue this grind higher, and if you look at some of the markets, they've put on around 10% in the last 2 months, and that's coincided with a fall in volatility as well. The VIX index, the US volatility index, has fallen to a 2-year low recently. So often we find that looking back in history, any bounces in equity markets following a recession for the first 12 months have been then followed by a sort of sideways to gradual, slow increase, and that seems to be what we're seeing at the moment. Crucial resistance levels really coming up for the markets, and in particular the S&P, as mentioned, around 11.87. The S&P is nearing that very psychological 1200 level. This is where the market was before Lehman went bust, and it's considered to be a key resistance level. So if we look at what clients are doing, they actually are long US indices at the moment, so expecting the S&P and the Dow to possibly test those resistance levels with a target probably around the 1200 for the S&P. But conversely on the FTSE, clients very much against the trend. They're still selling into the strength of the FTSE. On the commodities and FX front, clients remain short the dollar, so they're long both cable and euro dollar, expecting obviously a bit of a bounce. And on the front of gold, the recent strength in gold and oil has meant that a few clients have come in short of those particular markets. So for the rest of the week, not much in the way of economic data. We have interest rate decisions from the Bank of England and the European Central Bank tomorrow. So Bank of England will very much be focusing on whether they feel that the election will have any influence on their decision making. Unlikely, but of course they'll probably want to remain very muted until after the election in May. And for the ECB, we'll probably see a little bit more of a confidence statement, and certainly the economic data of recent, the sentiment data of recent, has been a little bit better. So we should hopefully receive a slightly more upbeat statement from the ECB tomorrow. So that brings us on to the theme of the week. Well, how can we not have a theme of the week without it being something to do with the election? What do financial markets do in the UK? What does the FTSE do during election campaigns? Well, really, in all honesty, very little. Volatility tends to be a little bit lower. The only time we've really seen a particularly volatile campaign was during the '92 election, when it looked like Neil Kinnock was going to win, but actually it turned out to be a Conservative government that was formed, and there was a bit of volatility there, presumably due to the uncertainty. But at the moment, with the polls looking like a Conservative victory, the market seems to be taking things in its stride, and unless we see a change, a narrowing in those polls, it looks like volatility will remain very, very low. So that's it this week, and as ever, if you have any feedback, do email us at media@capitalspreads.com.